Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. Even though one of the top companies in the S&P 500 has yet to announce earnings this quarter, the numbers that actually matter are already in. 93% of the S&P 500 has already reported earnings ahead of this week. 78% reported a beat on earnings, and 60% reported a beat on revenue. We're also reporting the highest level of earnings growth since the second quarter of 2022. What this means for investors is that earnings have recovered well. The question is, should we celebrate? If you like the gains we've seen thus far and wouldn't mind if we had a little more running to do, go ahead and pop the champagne. This is definitely good for stock returns present and future. But if you understand the threat of higher for longer interest rates, you may want to keep that bottle on ice, because this quarter definitely suggests that the inflationary gap is likely to last a little while longer. On top of that, Goldman Sachs is warning that the U.S. government will not have as much money to prop up the U.S. economy in 2025. With inflationary concerns accumulating, according to JP Morgan CEO Jamie Dimon, we could very well be in for a bumpy ride to this soft landing that everybody expects. In fact, Dimon thinks we are overly optimistic about a soft landing. In his words, whatever the world has priced in for a soft landing, it's probably half of that. Meaning, if the overall assumption is an 80% chance of a soft landing, there's probably only a 40% chance. Conflicts around the world make the likelihood of commodity price shocks extremely high probability. Copper has already been flying due to the shutting down of production. Now we have tankers and refineries being hit in our conflict between Russia and the Ukraine. Like it or not, Russian oil has played its key role in keeping oil prices subdued, as countries like China have continued to buy large quantities from them at lower costs. Add in the fact that whatever growth we see won't last long in a higher for longer interest rate environment, and the chances of something going wrong are much higher than people think. When markets are running higher, it makes people feel good. They start making the types of decisions you make when all is well, even when all is not. Like believing Apple must be headed to a $4 trillion valuation, so I better buy now. Tesla has so much room to recover. Let's pick up a few shares before stocks explode and they're back at $400 per share. Sounds like the exact same mistake we made in 2021. Let me remind everybody listening that we still have the possibility to see higher than expected inflation alongside stagnant growth. We know what that means when those two things are combined for an economy. So I think investors should definitely enjoy the gains, but do so while not losing sight of reality. The closer we get to 5,500 on the S&P, the more investors should focus on protecting their gains. At those prices, we would already be paying for 6 or 7 years worth of growth that we don't even know is coming. Investors can protect their portfolios by purchasing shares of the SPXU or SQQQ, or by buying long-dated put contracts against the indexes to protect against the potential for a minimum 10% drop from those levels. The last time we talked about buying protection was in April. We got a 7% drawdown from there and cashed in on some very profitable hedges. The next drawdown we see in the stock market could be much more severe. Being caught off guard will cause pain for many investors. A 10% drop in the market from 5,500 would take us right back to the April lows, which looks like it will likely be the neckline heading into a new bear market if things do go wrong towards 2025. We could see a failure to get back to the highs being our reality if we do ever revisit those April lows. Foresight is just as important as hindsight, and the only way to start cutting rates in 2024 is if growth slows enough to allow that to happen. I encourage investors to be safe out there. Enjoy your gains, but protect them when they come in excess of expectations. 5,400 to 5,500 on the S&P is going to look really good, but the pain those prices bring with them won't be so easy on the eyes. Investors must also be prepared for a second scenario. The chances that what we've seen thus far is as much as we're going to get. The reality is, we don't have the money supplied to support the valuations or the growth that these valuations promise to bring. Scenario number 2 would suggest investors start hedging against the potential return to the April lows a little early. Not only are stocks trading well off their 20-day moving average, but this recent rally back to all-time highs has been on lower volume, much less participation than we saw during the sell-off in April. One tip would be to open at least 1/3 of your short position now, as we're still likely to be trading below these prices later on down the line. The Equity Channel is one of the most followed stock market podcasts for beginners, a valuable resource for investors who are looking for information on the stock market and the economy. We love to make our episodes quick, straight to the point, and rich in value. We hope that's what you got today. Be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made.